Bring in Ruchir Sharma, Rockefeller International Chairman, Founder, and Chief Investment Officer of Breakout Capital, fresh off this new piece in the FT today titled "America is Now One Big Bet on AI." Ruchir, provocative piece, although over the weekend, Washington Post pointed out that GDP gets more contribution now from AI capex than all the spending by all the consumers in the country.
That's exactly what I've said in this piece, Carl, which is that if you just look at the AI spend, that alone accounts for 40% of GDP growth this year. But there are second and third order effects. The other is coming from the wealth effect from the stock market. In the stock market, as you know, 80% of the gains in the U.S. stock market this year are on the back of AI plays. Now, the U.S. stock market, as you know, the top 10% own nearly 90% of the U.S. stocks. And if you look at consumer spending in the U.S., it's all being driven by the top 10%. In fact, the top 10% have never had such a large share of the overall consumer spending in the U.S. as they have this year. So this is very much an AI story being played out at multiple levels. And even on capital flows, you spend the opening segment speaking about how France and even Japan are having troubles in their bond market. Now, the U.S., as you know, that the debt and deficit level, at least the deficit level in the U.S., is even higher than in France and Japan. But the reason the U.S. has lower yields than at the start of the year compared to those countries is because there's an implicit bet even in the U.S. bond market that America is going to see a big productivity miracle. And so therefore, these debt and deficit levels are very sustainable. So I think that that's really what's going on, that it's all about AI lifting the U.S. economy, even in the face of all the other negatives that are piling up.
So how do you explain the dollar weakness? Because I agree with you. I mean, the U.S. is the center of the world when it comes to AI, and that's driving a lot of investment. The U.S. economy has been remarkably resilient. Even the debt picture, as you said, there's more optimism around that right now with, they're bringing in money from tariffs and everything else, especially if you look at a basket case like France. So why is the dollar so weak?
Right. So the dollar is weak because I think that we got extremely overvalued at the end of last year. And a lot of people who are bringing money into America today want to hedge some of that capital inflow. So the capital inflows into America are continuing at a record pace. In fact, as I document in the piece, that the American stock market attracted nearly $300 billion of flows, even in the second quarter, which was a very tough quarter on the back of tariffs. But what's happening as I speak to a lot of investors, especially foreign investors, is that they're hedging some of that. And that's what's leading to some of the dollar weakness. And remember, the dollar's coming off a very expensive valuation at the beginning of the year. So yes, there is some hedging going on. And yes, I mean, I do believe the fact that the rest of the world is being discovered more now. I mean, I find it really fascinating that we have so much pessimism about Europe. And yet, as I point out in the article, that this decade, outside of the top 7 stocks, European stocks have in fact outperformed American stocks. So the point in the piece that I'm trying to make, Sarah, is that this bet on AI better pay off for America, because outside of that, the rest of the world has been outperforming.
Ruchir, do you think, I mean, we keep hearing more chatter about a productivity boom that really might not be that far away. In fact, we might already be seeing the early signs of it. Do you think that's relying on the capex that we're talking about, or actual adoption and use cases that might already be in practice?
I think it's an implicit bet on both, right? Which is because productivity has already been picking up even before the full AI effects have come into play. The productivity growth began picking up after the pandemic. So there's been a much more focus on cost efficiencies after that. And I think that people are now expecting that as AI is adopted more in the next few years, that will lead to a further pickup in productivity. So yes, the US bond market and even the stock market is implicitly betting on at least a 1 percentage point increase in productivity from here. And the reason I say that is that the only reason you can sustain such high real interest rates as we have now, compared to what we had in the past couple of decades, is if you end up getting an increase in productivity. So yes, the US market is making an implicit bet that because of increased AI adoption from here, that productivity growth will go up by 0.5 to 1%, at least from here.